Very few people talk about this in mainstream personal finance. $50,000 per year is structurally one of the most expensive income levels in America to live on. Not the lowest income, not the most taxed in absolute terms, but one of the most exposed salary ranges where key financial protections quietly begin to phase out. At this level, more forms of debt suddenly become accessible than at almost any lower income, and most people don't realize how quickly that changes their risk profile. The gap between perceived stability and actual financial fragility is widest right here, at the income that feels safe but leaves very little margin for error. This isn't opinion. It's what the math shows when you run the real numbers: take-home pay after taxes, benefit cliffs, and lender-approved debt-to-income ratios. When you factor in healthcare subsidy phase-outs and federal tax credit cutoffs, this income level can trigger some of the sharpest financial drop-offs in the system. Lay all of that out clearly, and 50,000 stops looking like a milestone and starts looking like a pressure point. Not because people are reckless, not because they're careless, but because the structure makes this level feel more secure than it actually is. And once you understand that structure, you can move differently. But first, you have to see it clearly. When you accept a $50,000 salary, your brain immediately does math. 50,000 divided by 12, that's roughly $4,167 a month. You start building your life around that number. You look at apartments, think about a reliable car, sketch a rough budget, and think, yeah, this is workable. Except $4,167 is a number you will never actually see. Not once, not a single month throughout your entire working year. After federal income tax, FICA, and state taxes, your actual take-home lands somewhere around $3,300 to $3,400 per month. That gap between what your salary sounds like and what actually lands in your account can be $800 to over $1,000 every single month. That's nearly $10,000 per year that exists on paper but vanishes completely before it ever reaches your bank account or your hands. Here's where it gets worse. This isn't just a math problem you fix by adjusting expectations. It's a psychology trap built into how salaries are communicated. Most people structure their financial decisions based on the gross number. They sign leases, agree to loan payments, and commit to monthly expenses, all with $4,167 in their head. Then, month after month, they manage real life on $3,300 and wonder why it always feels so unbearably tight and unforgiving. They don't feel like they're overspending. They feel like the math is broken. And in a way, it is, just not the way they actually think. The offer letter is the most expensive document most people ever sign, and almost nobody reads the fine print before putting pen to paper. The American benefits system is means-tested, which sounds neutral, but in practice, income thresholds cause government assistance and tax credits to phase out in sudden chunks. You cross a line and suddenly you're no longer eligible for things you had just a month ago. No warning, no gradual transition, just a cutoff. At $50,000, you were frequently right at that line, sometimes just past it, close enough to feel the loss, far enough to get no benefit. Subsidized health insurance under the ACA can see dramatic premium increases the moment your income crosses certain thresholds, even by just a small amount. The same plan that cost $160 a month at $48,000 in income can cost $310 or more at $50,000. That's over $1,800 per year in additional expense, triggered by a raise that may have only added $100 to $150 monthly after taxes. Do the math slowly. A raise that produces $130 extra per month after taxes, but triggers $150 in higher insurance costs every month. You got a raise and you are now worse off. The raise cost you money. That is not a hypothetical. That is a mathematically real outcome for many earners. This isn't a glitch. This is the system working exactly as designed, and nobody sat you down to explain it before you accepted that offer letter. The same cliff-edge logic applies to tax credits, childcare subsidies, and various state-level assistance programs, all phasing out around this exact income range. The $50,000 earner is too wealthy to qualify for meaningful support, but too underfunded to absorb the full cost of living without it. You're in no man's land. Too much income to get help, not enough income to not need it. Structurally stranded between two worlds that both deny you. Take-home pay, roughly $3,300 per month. Now try to build a normal, not extravagant life on that number. Here's what it actually looks like. A modest one-bedroom apartment in most mid-sized American cities runs $1,100 to $1,200. That's your first and largest committed expense. A used car with a payment, nothing fancy, just reliable transportation, adds $350 to $400 more to your monthly obligations. Auto insurance runs $150 to $180. Gas adds another $130. Groceries for one person cooking at home, $300 to $350. Student loans, which 43 million Americans carry, add $250 to $350 monthly. Utilities, phone, and internet together run roughly $220. Health insurance adds $300 or more, and remember, this is after your ACA subsidy has already been reduced or eliminated at this income level. Add that up, you're at $2,900 to $3,130 in committed monthly expenses before a single discretionary purchase has been made. That leaves $170 to $400 as your entire margin for everything else: clothing, medical copays, a car repair, a dentist visit, a friend's wedding. That margin is not a budget, that is a prayer. And one unexpected expense is all it takes to make that prayer go completely unanswered. A car repair, an unexpected medical bill, a rent increase at lease renewal. Any single one of these creates a gap that doesn't close on its own, because there was never any slack to begin with. So the gap gets filled with credit, and credit at 22 to 25% APR compounds fast. That kind of debt doesn't get paid off with a $200 monthly surplus. It grows, quietly, consistently, until it becomes the dominant fact of your financial life. This isn't a story about bad decisions. This is what the math looks like at this income level when you simply live a normal American life. Middle-income earners, roughly $40,000 to $80,000, carry revolving credit card debt at significantly higher rates than both low-income and high-income households. Federal Reserve data consistently shows this pattern. It's counterintuitive at first until you understand the precise mechanics that make it almost inevitable. High earners don't put emergencies on credit because they have savings to absorb disruption. Low earners often can't access high credit limits in the first place. But the person earning $50,000, they qualify. Lenders see stable income and extend $10,000, $15,000, even $20,000 in available credit. The $50,000 earner has enough income to qualify for significant debt, but not enough financial buffer to avoid actually needing to use it. Credit card companies didn't design their products for rich people. Rich people don't need them. They designed them for people living exactly close to this edge. People earning enough that a $500 emergency becomes a revolving balance, but earning enough that the minimum payment stays just manageable enough to keep paying. Manageable enough to keep paying, not large enough to eliminate the debt. That's the design. That's the product working exactly as intended by the people who built it. A $5,000 balance at 24% APR, paying only minimums, takes over a decade to clear and costs more in interest than the original purchases combined. The tire that costs $600 ends up costing $900. The ER copay put on the card in January is still accumulating interest come December. Every emergency financed with borrowed money is quietly more expensive than it first appeared, and the real price only reveals itself months later, buried in a statement. The system, lenders, card networks, banks, profits every single time someone makes the minimum payment and carries that balance forward into the following month. The $50,000 earner is the perfect customer, qualified enough to access the debt, stretched thin enough to need it, and just stable enough to keep paying indefinitely. There's a critical distinction the financial industry works hard to blur: the difference between what you qualify for and what you can actually sustain long-term. When a mortgage lender evaluates your application, they use gross income, not take-home pay, not your full monthly obligations. Their math and your real-life math are different documents. Their debt-to-income formula is built on pre-tax earnings. A lender might approve you for a payment representing 28% of gross income, which sounds conservative and responsible. But that same payment lands at 40% or more of your actual take-home pay. Suddenly, that conservative-sounding approval becomes a significant monthly financial strain. Being approved is not a signal that you can afford something. It's a signal that you generate enough cash flow to service the debt while technically surviving month to month. The lender cares about whether you can make the payment. You should care about whether you can make the payment and still live. Those are very different things. This applies equally to car loans, personal loans, and credit limits. The approval is a sales tool dressed up as an endorsement, and most people treat it as the latter. A useful filter before committing to any significant monthly payment. Ask whether you could absorb that payment plus 30% more without meaningful stress or disruption. Because costs rarely stay flat. Insurance increases. Maintenance arrives uninvited. The comfortable payment today becomes the painful one 18 months later when other expenses have also quietly crept up. The approval letter tells you what the lender needs to know. The 30% buffer test tells you what you actually need to know before signing anything. There is no clever trick here, no hack, no loophole, no one weird strategy. What actually works is deliberate, uncomfortable, and slow, and it genuinely works. The foundational move: consciously decide to live below what your income technically permits and redirect that difference toward invested assets that actually compound over time. Not cash sitting in a checking account where it gets quietly absorbed by the next disruption. Compounding assets. That distinction is everything in the long-term outcome. The reason this is so difficult isn't willpower, it's social. At $50,000, there is enormous ambient pressure to spend like someone who earns $50,000. The apartment that fits the income, the car that signals professional arrival, the wardrobe and restaurants that say you've made it, the lifestyle that matches the salary on paper. But financing that lifestyle on that income is exactly the trap. The appearance of having made it becomes the mechanism that ensures you never actually do. The person who earns $50,000 and genuinely lives on $38,000, not out of deprivation but financial clarity, has $12,000 per year to redirect. Invested consistently over 10 years at moderate returns, that $12,000 annually becomes real capital. Capital that doesn't require showing up to a job you can't afford to leave. Capital that creates options. That is the actual goal. Not a higher salary, not a bigger apartment. Options. The ability to choose what happens next in your own life. The automation principle is non-negotiable. The money that builds freedom is the money that moves before you make any decisions about it, before it touches your hands. Route savings and investments off the top the moment your paycheck lands. You will adapt to whatever remains. Humans are remarkably good at adjusting to fixed, non-negotiable constraints. If you try to save what's left after spending, there is rarely anything left. That's not a character flaw. That's just how human psychology interacts with available money. Automate first. Build the constraints. Live within them. That sequence, in exactly that order, is the entire framework. Everything else is detail built on top of it. Every dollar you spend today is a vote for your current life. Every dollar you invest is a vote for your future options. That trade-off is happening whether you're aware of it or not. Options. Real, tangible options about where you live, what work you do, whether you stay or leave. That is what financial freedom actually means at its core. Not a yacht, not some abstract early retirement number, just the ability to say no when it matters, to walk away from something that isn't working for you anymore, to not be locked in place by the payment schedule of decisions you made 5 years ago. That kind of freedom is what's actually being bought or forfeited every single month. At $50,000, the system is very good at ensuring every dollar is already spoken for before it even arrives in your account. Rent, loans, insurance, utilities, all deducted automatically. You live on what's left, which is usually very little, and that remainder, that thin margin, is what you're expected to somehow build a stable financial future from. The people who escape that pattern aren't always the ones who earned more. They're the ones who interrupted the sequence before the system could finish claiming everything first, who paid their future selves before they paid the system, who made different choices about cars and apartments, not from unusual discipline, but from understanding what was actually at stake. The $50,000 income isn't the problem. The assumption that it automatically translates into stability, that's the problem. That assumption is doing enormous quiet damage. Once you stop believing that assumption, you can start building something that actually holds, something that doesn't depend on everything going perfectly just to break even each month. The math is patient. Compound growth doesn't care when you start, it only cares that you do, and that when you do, you don't stop.